So let's talk about interest rates. It is the hot topic. I mean, interest rates are the highest they've ever been since I've been in the business, and I've been in the business since the early 2000s. People are kind of freaking out. So I thought I'd pull back the curtain and lay out like where rates come from and the factors that go into interest rates and the different types of lenders and how they are affected by rates. So what I'm going to do is start with where rates come from. They start in Wall Street in the form of mortgage-backed securities, and then Wall Street says, you know what, I will lend to you Fannie, Freddie, and Ginnie at a certain interest rate. In this example, I just use 6%. And if you haven't heard of Freddie and Fannie are conventional, and Ginnie is like the government loans, FHA, VA, USDA. And those three entities say, all right, all you lenders out there, this is the interest rate we're going to give you. So there's a little, you see, there's a little add-on of 0.25 as they get to the lenders. And I have PNC, Rocket, and Collab lending in there. PNC being in a depository institution bank. Rocket is more of a correspondent lender, and Collab lending is we are a broker. And I'll get into the differences between those types of lending. And so as the lender, we offer an interest rate to the borrowers, which also has an add-on. That's how we make money. And then the borrowers, once they have their mortgage, those mortgages are packaged into mortgage-backed security. So that's the life cycle of interest rates. Obviously, I put a clock there because it just goes around clockwise there. And then the big question I always get is, what's your interest rate? Now, when I started in the business, I was almost strictly doing LendingTree, where you're competing with 3 or 4 other lenders to win someone's business. And it is the shark-infested waters that the commercials portend. And I really was getting my butt handed to me because I was giving legit interest rates, but there's so many loopholes. And number one, you see here, there are so many factors that go into an interest rate. It's not just credit score and what kind of loan you're doing. And one of the things to know is that I have credit score and credit history up there. People will sometimes, it doesn't happen a lot anymore, but they'll say, what is your interest rate? And it's like, well, what are you trying to do is usually my retort to that, or what are your goals? Because if you're looking for the lowest interest rate, well, technically FHA loans, government loans like FHA, VA, USDA, they have the lowest rates, but they also have private mortgage insurance. So when I hear that question, I over the years, what I've realized is people are just saying, hey, I'm making the largest financial decision and most emotional financial decision of my life. Can I trust you? Are you going to take care of me and give me a fair rate? And I have credit score and credit history there because people say, well, I don't want you to pull my credit because they've been told. I hear this, on a weekly basis. I don't want you to pull my credit because I don't want my credit score to drop, which isn't really true. As much as I think the credit scoring agencies are a racket, they do get it right when it comes to credit scoring. They see mortgages as good debt because it's an appreciating asset. And when it is a hard pull, there are certain lenders who can do a soft pull. We are one of them. We can do a soft pull in your credit, but a hard pull in your credit, that hard pull term lumps it in, a mortgage hard pull lumps it in with the negative hard pulls that can drop your credit score, like applying for credit cards, especially when you're already in debt, or a car or a motorcycle or a ATV, because those are depreciating assets. And credit cards obviously are considered bad debt. So yeah, too many pulls on your credit, hard pulls on your credit, that will drop your credit score, but not a mortgage. And the advantage of having the mortgage entity pull your credit is because they're going to be able to give you a much better estimate of what your interest rates and fees are going to be. So don't be afraid to have your credit pull. I mean, I've seen 7 or 8 credit pulls for 800 credit scores. I don't advise that. You should probably be able to lock in on a legitimate mortgage lender with 1 to 3 pulls, I would think. So having to finish up that part of it, having been a LendingTree, I don't really get shopped that much because, as I'll show you here in a little bit, I'm a broker, and the brokers in general are going to have the best rates, and they are taking over a lot of market share, especially in interest rate environments like we're in today. So what are the mortgage entities that I was talking about? Well, there's banks, there's correspondent lenders, and there's brokers. That first row there, it's just my experience. I've been all three. I've been worked in a depository institution like a PNC or Fulton Bank, Suncoast, that's where you walk in, you may have your checking or savings account there. I've been a correspondent lender, which is sort of a blend between a broker and a banker. And so to kind of really go into how these differ, let me just start with banks and what they do. So a bank will take your application, they'll process your loan, they'll underwrite your loan, they'll lend the money, and they'll service the loan. So your mortgage payments will go to that bank. An advantage of that is you have a control of the process, and there's some familiarity. If you're going into a bank and you're depositing money or withdrawing money, you kind of get to know the people in there. So there's a familiarity with that. But the disadvantage is it's limited in products and guidelines. That bank has their specific products. They're usually more conservative on the guidelines. For example, most banks will not lend on a conventional loan less than 640 credit score, where as a broker, we can go down to 580. And then overhead is a huge one because, the banks have their legal department, they have the marketing department, they have the underwriting department, they have the processing department. Well, how did they pay those individuals to work? Well, it's in the rate. The customer's paying for that. So they're in general going to have the higher rates at a bank. And then you have the correspondent lender, which pretty much does everything a bank does, except they don't service the loan. When you work for a correspondent lender, you're like a broker. You kind of have the ability to shop the rates around to different wholesale lenders and see who has the best rates that day, and that's who's going to end up servicing the loan. Like a bank, you have control of the process, but unlike a bank, you can shop the rates like a broker can. But the disadvantage, just like a bank, is the overhead. They all have their legal departments, their marketing departments, their underwriting, their processing. And then a broker. Now you see there, I was correspondent most of my career, and I've been a broker for 5 years. 2 years the first time, and now I've been with Collab Lending for 3 years. And the first go around was not a good experience because my loans weren't closing. And in all fairness, that was just because we were a new brokerage. And the banks that we were using, the lenders that we were using, we didn't have a reputation yet. We hadn't given them volume. So they just weren't giving us any love. So I got out, actually went into the banking side. And then I became a broker, and I've been there ever since. And the broker, we just process the loan, and then we shop around, see who has the best rates. And whoever we send it to, they'll underwrite it. They'll lend the money. They may or may not service the loan. And you see the advantages there. You have the ability to shop rates. There's low overhead, so the costs are not as high, which means that the borrower is getting a better rate. Wide variety of loan products. I think we deal with almost 30 different wholesale lenders, and then we also, me personally, as a loan officer, I can talk to underwriters, but it's not really encouraged. But the person on my team that works on my loan, they have direct access to the underwriter, so they can ask, what are you looking for? Now, banks also have that advantage. I'll give that. I don't have that in there, but you can do that with the bank sometimes. When I worked for the bank, I was not allowed to talk to the underwriter, because if the underwriter is like trying to get work done, they can't get work done if they're taking calls from loan officers, because loan officers can tend to be a little bit overbearing. So we as a broker, the underwriters are more willing to talk to our team. And then the disadvantage of a broker in most cases is the control of the process, which was, my first go round. That was the problem, that we weren't getting any love because we were new. So the ideal is to be a broker and have control of the process, meaning working with wholesale lenders who work with you. They feel that you are important, and my loans close now faster than they did when I was working for a bank or a correspondent lender. On the purchase, I think my record is 14 days between contract and closing, and the refi is 9 days. So I found a sweet spot as far as being a broker, and I don't think I could ever go back. Brokers now, with the way that the interest rates are so high, brokers have so much flexibility on the interest rates that they can offer. We're more competitive. We're more competitive in general, but especially in the market we're in now, where inflation is causing interest rates to increase. So that's my 2 cents, well, at least the first part of interest rates. If you need to get in contact with me or have questions, you can always feel free to reach me, and please follow me on social media. I'd really appreciate that. And if you got anything out of it, like and subscribe to my YouTube channel. All the best.